Nigeria's external reserves plunged for the 10th consecutive day on Friday, 30th April 2021, as it dipped $27.74 million to close at $34.9 billion. According to the latest data released by the Central Bank of Nigeria, the reserves, which had been fluctuating, rose from $34.85 billion as on April 1st before returning to a downward path in the middle of the month. CBN had recently attributed the improvement in the level of external reserves to the recent upsurge in crude oil prices on the backdrop of renewed optimism on the successful deployment of COVID-19 vaccines across the globe. In its quest to manage the external reserves and save the naira, the Apex Bank introduced the Naira for Dollar initiative as a way to encourage remittance inflows through official channels and increase foreign exchange liquidity in the country. With the 2-month period of the Naira for Dollar initiative almost over, Forex scarcity still persists, and this has contributed to the rise in inflation in the country. Joining me, like I said earlier, is the head of investment research, United Capital PLC, Mr. Wale Olusi. Mr. Olusi, thank you very much. It's good to see you. It's been a while.
Yes. Good afternoon, Tolu. I'm happy to be here.
Yep. First, in 2 weeks, $350 billion of our reserves. What does this mean for our country?
Well, I think the issue with the external reserve of Nigeria always boils down to one thing. What are we really selling as a country? If you break it down, the bulk of our export earner is still, petroleum, oil and gas account for over 80% of our total exports. Other items are fringe. They are very, very insignificant. And don't forget, between last year and now, we've not been getting a lot of inflow in form of foreign portfolio investment or even foreign direct investment, partly on the part of the pandemic, and partly because foreign investors are not very comfortable. They don't see certainty around the exchange rate environment here in Nigeria. So if you put all of those things together and the fact that the central bank needs to meet import demand every now and then, even though there are a lot of controls around it, there's no way the external reserve would not be under pressure. In fact, if the central bank wants to actually provide enough liquidity in the exchange rate market as much as they should, we should have had much more than the decline will have been more than that, because there's a lot of backlogs that are not yet met. So what is happening is basically demand for FX is basically much more than the supply, hence your reserve will be depleted.
Okay, Wale, let's move on with the efforts now by the Apex Bank to address all of this challenge, at least to shore up external reserves, Naira for Dollar, diaspora remittances, everything just to shore up for external reserves. Now, would you say this is playing out well for us? We've seen countries where this worked so very well. We have examples of countries where all of these policies have worked. But would you say it's a plus for Nigeria, or are we still just scratching the surface?
Well, I think the best measure of whether all the efforts of the monetary policy authorities around exchange rates, you can very easily verify whether it is working or not when you look at what the market is saying. So long as you have the official rate at about 378 or 379 naira to a dollar, and then you have the I&E window rate at around 410, and then far away from all of that, you have parallel market rates hovering between 480 and 490 or 500. Of course, there are also some rates in between all of these three major rates that I've mentioned. So long as you have that disparity and that divergence in the currency market, that tells you one thing: whatever we are doing is not yet working. Maybe it will work, maybe These diaspora remittances, incentive that the central bank is trying to do. Maybe it will work, but for now, it's not yet working. The amount of inflow that we are seeing in the system, does not, in any way have any impact on the level of demand that is in the system. Hence, that wide divergence between the official market and the non-official market. Once the policy starts working, once there's liquidity in the system that is enough, the first thing you will see is that the parallel market rate will collapse. It will move towards where the official market rate is. So long as that is not the case, if the pressure persists, what you will see is a situation where the monetary authority continue to shift from where they are currently towards the parallel market. But for now, we don't even know where that movement is going towards. Maybe by the time the Eurobond offering, which the government have mentioned that they want to do, comes in, there would be some more liquidity and CBN will be able to offer more injection into the FX market. Maybe we'll begin to see results then, but for now, there's no actual result that we can point a finger at.
Let's now see the risks. What are the risks in all of this for the naira? What are the risks for our currency? Do you see further devaluation of the naira if we continue like this?
To be very honest with you, I'm very afraid about the possibility of a further devaluation. And the reason is simple. If you look at the communication from the National Oil Company, the NNPC, recently, stating clearly that oil earnings is under pressure, not because oil price is not at 66 or 67, but because of subsidy that we continue to pay, to keep the petrol price at the current level. Once there's a lot of pressure on government revenue, what that means is that at some point, you will begin to think along the line of where am I getting my money from? A good chunk of Nigeria revenue, about 75 to 60%, comes from oil. That oil comes in form of dollar. The dollar is translated to naira as 379 naira. That's the official rate. Now, one of the tricks a government can use to increase revenue in naira terms is to simply just adjust the official rate a bit towards 400 or beyond that. Once you are pushed to the wall and you have to do that as a government, that means you are effectively devaluing. So long as there's a continuous pressure on the finances of government, there's that risk there that we may further devalue. So long as the parallel market rate is wide compared to the official market rate, and we are not, attracting enough FX inflow, that probability will remain there. So I think that's best I can say, except we do something that is bold, that can attract FX, and very quickly too. The probability of a further devaluation, the risk of a further devaluation will always be there. Tolu.
All right, even with the pressure of inflation, purchasing power continues to drop by the day. In all of this, as countries struggle to recover, we see the International Monetary Fund coming to say countries like Nigeria can still borrow more. Mr. Lucy, I'm worried about this.
Well, we should all be worried, because when government borrow, they have to pay back. And when they have to pay back, they will either have to tax us more or defer some of our future income, either from oil or from taxes, to pay back those loans. So somehow we still have to pay back, either directly or indirectly. So we all have to be worried. But in terms of what the IMF is saying, they are basically looking at the size of your GDP and they are looking at the size of your loan, and they are like, well, you still have some headroom. But for us as analysts, and of course for many investors also, that's not what we look. For us, we don't really care about the size of your GDP to the amount of debt you have taken. What we care about in the private sector is your capacity to pay back. Are you credit worthy? For Nigeria, what we look at is what is the revenue mobilization compared to the to the debt ratio, and that's where the problem is. If you look at the last couple of years, Nigeria we've been spending a lot of money servicing debt, almost 50% of more, 50% or more than the amount of revenue we are generating every year is going into either servicing debt, both locally and international debt, as well as paying those debts back. So that's where the worry is. Nigeria basically need to do something drastic about revenue mobilization. The economy is huge. I think that's what the GDP number is saying. But we are not sweating, the income generating power of that economy enough in terms of revenue as a government. And you can't blame the populace also, because if you want to sweat the populace, they will ask you, what are you doing for us? In place of this increase in taxes that you want to. So we should not be worried about debt, but government have to borrow because they need to pay salaries, they need to fix infrastructure and do all of these things. But sadly, you know, um, borrowing is probably the only way that they can do that for now until we come up with an ingenious way to generate extra revenue to do that.
Almost finally, the CBN has continued to intervene. We know that. They've been doing this. But sustaining this move is something that we've talked about, I know, before now. With the present situation and what we see of the reserves, how well do you see CBN sustaining this market? The BDCs are on one side also wanting funding from the central bank. They want to be included in the IMTOs that are picking the funds from diaspora remittances. Where do you see the CBN standing in all of this? How can they sustain this?
Well, I think the CBN is basically biding time. They are trying to keep it all together for as long as they can. So far it has been good. They've kept parallel market rates, at below 500, and they've done a number of devaluation. But I mean, we are still around 410, at least for the official segments. Well, can this be sustained? Definitely not. We can't sustain this. Like I mentioned earlier, I think if the plans around foreign borrowing that the Senate recently approved, if it works, if they can, within the next 6 months, increase the size of the USD, the dollars in the external reserve from 35 to around 40, maybe that can give them some breathing space to begin to provide liquidity in the currency market. And then if they can also, because they've also become very, very aggressive with monetary policy tightening, meaning they are selling more OMO, they are a bit more aggressive, they are increasing interest rates. If you check the yield environment has also increased. So I think if the increase in the yield environment is also sustained to the extent whereby it begins to attract foreign portfolio investments, once that starts coming in, then they can begin to provide liquidity, and then maybe some of the pressure will begin to ease off. But holding everything together at the current level where it is very, very unsustainable. I think while holding all of that together, they basically just need to, find a way to do something that will attract, foreign capital, either in form of Eurobond borrowing, or international debt from multilateral institutions or bilateral institutions, or in form of OMO, whereby you sell treasury bills to foreign investors and they come and take it. But before they will be able to get that, they need an interest rate that is quite attractive. I think that's where we are now. Some of us are waiting for the next MPC meeting to see what the CBN will do. Then maybe that will give us an indication of where exactly we are going in terms of it.
Let me quickly, Brajin, if you can do that to wrap up. Any expectations? What are you thinking about? What do you think will be the key issues at the next MPC meeting as we wait for that committee?
Well, Tulu, I think the key issues are quite obvious. Inflation is at 18.2%. Food inflation is over 22%. That's record level high. GDP is still quite weak. Exchange rates, there's still a lot of divergence. But I think inflation is a top priority for this MPC. So I think they will probably want to do something about maybe the MPR, something to pull back inflation, because one of the things you can do is to also solve the exchange rate problem. That's probably the easiest thing that will affect inflation immediately. And one of the ways to solve it is what we've been discussing all day. Bring in enough liquidity into the system and provide supply the FX market. That way, those who want to import food can import food, and they can bring it in and the prices can ease up. Maybe they can also advise the federal government to do something about the state of insecurity in the country, so that food movement from the north to the south, from the south to the north can also ease, and then, inflation can begin to pull back.
I must thank you for your time, Head of Investment Research, United Capital PLC, Mr. Wale Olusi. Thank you so much for joining us this afternoon.
I appreciate it.